This lecture is over dividends and dividend policy. I'm your professor, Dr. Stephen Haggard. Let's start by talking about cash dividends. It's useful to remember that dividends get paid out of net income, cash dividends that is. Net income flows to dividends and to addition to retained earnings. So anything that gets paid out as a cash dividend is not going to be added to retained earnings, which is part of owner's equity. So there's a trade-off. Any dividend that gets paid out actually reduces the owner's equity in the firm. Now there are different types of cash dividends. There's a regular cash dividend. These are the ones that shareholders expect to receive on a regular basis. It's usually each quarter. And companies will work very hard to maintain this level of dividend payment, because if they stop paying dividends or reduce the amount that they pay, shareholders will punish them and the market price will drop as a result. Why? Because it's a signal for management that they expect future earnings will not support the current level of dividends. That's why managers are so reluctant to cut dividends, but also why they are reluctant to raise dividends. This is why we say dividends are sticky. Managers will not raise dividends until they absolutely know that they can support that level of dividend payment in the future using the expected cash flows of the firm. On the other hand, they will also be reluctant to cut cash dividends if they see shortage of cash in the company's near term. Then we might have something called an extra cash dividend. This is an indication, if the company says it's an extra dividend, this is an indication that it might not be repeated in the future, so you might not want to depend on this payment of cash. And a special cash dividend is like an extra dividend, but it definitely will not be repeated. For example, when Microsoft first started paying dividends, they paid a special cash dividend to pay down a certain amount of the cash they had on hand. And it appears that Apple is doing something similar. Then finally we have the liquidating dividend. This is when some or all of the business has been sold or is being wound down. For instance, if you opened a catering business specifically to serve people at the Olympic Games in London, then at the end of the games what you would want to do is sell all of your equipment and pay your shareholders a liquidating dividend, because after all, the purpose of the firm will have been served and the firm will no longer have any need to exist, and so the equity of the firm should then be paid out to the shareholders. Now, if net income is smaller than the dividends, payment of a dividend will actually reduce retained earnings, accumulated retained earnings. And a liquidating dividend even goes beyond that and eliminates paid-in capital as well. Now let's talk about the mechanics of dividend payment. First of all, we know from our study of stock that the dividend is not a liability of the firm until it is declared by the board of directors. The date upon which they do so is called the declaration date. That's the date the board declares the dividend and it becomes a liability of the firm. After that, if the firm doesn't pay the dividend, then the shareholders can force the firm into bankruptcy. But this is the only way that shareholders can force the firm into bankruptcy, if the board declares a dividend but then fails to pay. Now there's a date called the ex-dividend date, and it occurs 2 business days before the date of record. In theory, any shareholder on the date of record, in other words, their name is recorded on the roll of shareholders, will receive the dividend. And if you're not on the rolls of the firm on that date, you will not receive the dividend. In order to make sure that your name is on the records, then you need to have the shares purchased by the day before the ex-dividend date. So if you buy stock on or after the ex-dividend date, you will not receive the dividend. Ex is Latin for without. So ex-dividend means without dividend. The day before the ex-dividend date, the shares are said to be cum dividend, C-U-M. It's Latin for with. Now when the dividend gets paid, actually on the ex-dividend date, the stock price generally drops by about the amount of the dividend. Why do we say about? Well, in fact, taxes make a complicating factor here, and so the stock price won't drop. It'll drop almost as much as the amount of the dividend. Now the date of record, we've already mentioned, the holders of record are determined and they receive the dividend payment. But in order to be on the rolls on that day, you have to own the stock by the day before the ex-dividend date. And then there's the date of payment. That's the actual date that the checks are mailed. Let's talk about figure 17.2. I think the number may be different in your book, but the figure's the same. And here's the general idea. X date here is 0 on the timeline. And on the X date, the price drops by the amount of the dividend that's paid. But this will only be true in a world without taxes. Let's talk about why that would be. If you bought the stock on the last day before the ex-dividend date, you'd pay $10 for it. And the next day you would have a dividend worth $1 and a stock worth $9. That means that you haven't gained or lost anything because of the payment of the dividend. If this were not true, then there would be arbitrage opportunities. In other words, opportunities to make riskless profits as a result of this process. Once you introduce taxes, then this gets a little more complicated. For instance, in the United States, the dividend tax rate is 15%. And so if we assumed all the investors in the company were Americans, the payment of the $1 dividend would cause the stock price to drop by 85 cents because the shareholder afterwards would only have 85 cents plus the $9 stock, $9.85, if the shares dropped by their entire amount of $1. So if they only drop by 85 cents down to $9.15, now the stock is worth $9.15 and they have the dividend of 85 cents. So once again they are made whole and still have their $10. Now there is an opportunity for people who live in countries with lower dividend tax rates than the United States. They can buy the shares on the day before and sell the shares back on the ex-dividend date and make a small profit due to the differential tax rates in their country. This next question is one that we've debated in finance for many decades now, and that is, does dividend policy matter? Now we know from our study of stocks that dividends themselves do matter because the value of the stock is just the present value of the expected future dividends. But it turns out that dividend policy may not matter because dividend policy is a decision to pay dividends versus retaining the funds to reinvest in the firm. If I pay out dividends, then I don't have that money to reinvest in the firm, and that will make future dividends lower. On the other hand, if I don't pay dividends today, that may allow me to invest in projects that would allow me to pay higher dividends at a future date. And the general idea is that dividend policy may not matter at all, and that's what we'll talk about in the next slide. Here's an illustration to show how dividends can be irrelevant. Consider a firm that can either pay out dividends of $10,000 per year for each of the next 2 years, or can pay $9,000 this year, reinvest the other $1,000 into the firm, then pay $11,120 next year. Our investors require a 12% rate of return. If you find the present value of those cash flows, both sets, you'll see that the present value is $16,900.51. In other words, they're exactly the same. If the company earns the required rate of return of 12%, then it doesn't matter when it pays the dividends. Let's go back and look at those numbers and see why that is. If we take the $1,000 at the end of year one and invest it for a year at 12%, at the end of the year we would have an extra $1,120. That's why a second dividend of $11,120 along with an initial dividend of $9,000 has precisely the same present value as two dividends of $10,000 per year for the next 2 years at the same required rate of return. So when might a low dividend payout be desirable to shareholders? Well, a while back, dividends in the United States were taxed as regular income. Right now, they're taxed at 15% across the board. But back when they were taxed as regular income, that meant some people were paying as much as 35% tax on their dividends. At the same time, the capital gains tax was 20%. And so those people would definitely prefer to receive their gains as capital gains that are taxed at a lower rate. Furthermore, capital gains, you get to choose the timing of when you receive them. How? You don't receive the capital gain until you actually sell the stock. So you can choose when to receive that money. And so there's a valuable timing option that goes along with capital gains that you don't get with dividends. Dividends show up in your mailbox whether you want them or not. And then there's flotation costs. Whenever we issue new securities to raise funds, whether it be equity or debt, there are always costs to doing this, and these costs are called flotation costs. If I can retain money inside the firm and avoid issuing shares in the future, I can keep my flotation costs down because there are no flotation costs for sources of internal sources of equity. And then finally, there may be dividend restrictions in the bond contracts. In other words, sometimes firms issue bonds. And many times bond holders, as part of the agreement, require that the firm limit its payment of dividends, especially if net income is low or net working capital is low. Why do they do this? Why, to protect their ability to get paid back, of course. If the firm is running low on net working capital and then pays out a large dividend, that's going to lower cash, and the firm might not be able to meet its short-term obligations, which means the suppliers could put the firm into bankruptcy, which would be damaging to the bondholders. Also, the firm could issue a lot of debt and immediately pay out a huge dividend to all its existing shareholders and then declare bankruptcy, effectively stealing money from the bondholders and paying it out to the shareholders. So we've made the argument for low dividend payout, but there can also be arguments made for a high dividend payout. So when might be desirable for the firm to pay a high payout? Well, there are certain groups of people who desire current income. For instance, retirees like my father. My father truly enjoys getting dividend checks in the mailbox. Why? That's how he funds his consumption, is through dividends on shares of stock that he bought during his working years. Then there are also groups that are prohibited from spending the principal of their investment. In other words, trusts and endowments. For instance, here at the university, we are only allowed to spend the income on the initial amount. We are not allowed to spend capital gains. And so we need to either receive interest or dividends in order to be able to use that money to fund programs here at the university. Then there's this concept of uncertainty resolution. That's the fact that there's no guarantee that higher future dividends will materialize. Earlier we made the argument that it was irrelevant if the company paid out dividends now or kept that money and invested it and paid out higher dividends in the future. Well, there's no guarantee that the investments they make will pay off, and so you end up with what we call the bird in the hand argument. There's an old American expression, a bird in the hand is better than two in the bush. The dividend paid today is the bird in the hand. The higher dividend that may or may not be paid in the future are the two birds in the bush. And then finally, there are tax considerations. First of all, dividends accepted by corporations have an exclusion. Corporations do not have to pay taxes on the first 70% of dividends they receive. And if they own more than 80% of the shares in the corporation paying the dividends, they don't have to pay any taxes at all. And so it wouldn't matter to them that capital gains tax rate might be lower or that they have a timing option with capital gains because they don't pay taxes anyway. And then there are tax-exempt investors that don't have to worry about the differential treatment between dividends and capital gains. For example, pension funds. Pension funds don't pay taxes on dividends received, and so there is no reason for them to be concerned between dividends and capital gains. We've discussed this a little earlier, but let's discuss it in more depth now, and that is the use of dividends as signals. Why would we use dividends as signals? Well, it turns out that we have a situation of asymmetric information. What does that mean? It means that one group of people has more information than another group of people. In this case, the managers have more information about the health of the company than do investors. And changes in dividends convey that information. For instance, dividend increases might tell us that management believes the new level of dividends can be sustained, which would tell us that management thinks future earnings are going to be consistently higher than previous earnings. That's good news. And so this might lead you to expect even higher future dividends, which would increase the present value of the firm. Remember, the constant dividend growth model tells us that the higher the growth rate of the dividends, the more valuable the firm is. And that's a sign of a healthy, growing firm. On the other hand, dividend decreases are bad news. This says that management believes it can no longer sustain the current level of dividends, which tells us that management believes future earnings will be lower than present earnings, and that's always bad news. And so that expectation of lower dividends goes on indefinitely, and it decreases the present value of the firm. This is also a signal of a firm that's having financial difficulties. If the firm is running low on cash, paying a dividend is the last thing it will want to do. We also talk about the clientele effect for dividend payments. There's a group of people who prefer low dividend payouts and will buy stock in companies that offer low dividend payouts. And there's also a group of investors who prefer high dividend payouts and will buy stock in those companies that offer high dividend payouts. If clientele move from one group to another, firms will change their dividend policies to chase the new clientele. In other words, the market will eventually balance out the supply and demand for the stocks for both low dividend and high dividend payout firms. In general, if the market is in balance, does it matter whether a firm adopts a low dividend payout policy or a high dividend payout policy? Not really. It's just changing one set of investors for another when it does so. And so once again, dividend policy does not matter. A stock repurchase can be a substitute for payment of dividends. Let's talk about what a stock repurchase is. This is where the company buys back its own shares of stock. And there are basically two ways it can do this. One is through a tender offer, where the company states a purchase price and the desired number of shares it wants to buy. More common, though, is the open market repurchase. That's where the firm buys its own stock in the open market. Firms will announce their intention to purchase a certain quantity of stock, either number of shares or number of dollars, and they will say that they will buy that opportunistically in the market. What does that mean? That when they think the stock price has fallen artificially low, they will repurchase shares. And when the stock price they feel might be artificially high, they will stop their repurchases until the share price comes back down to a more reasonable level. The open market is far more popular, but far less certain, because after all, this isn't a firm commitment to buy shares. It's just a plan that the company puts out there. They are not legally bound to purchase the amount they say in the open market. Now, a stock repurchase can be thought of as being similar to a cash dividend in that it returns cash from the firm to the stockholders. However, the cash is only returned to the stockholders that choose to sell their stock. There are some things we need to take into account when deciding whether or not to do a stock repurchase. Stock repurchases allow investors to decide if they want the current cash flow and associated tax consequences. In other words, investors choose when they're going to receive the taxable cash flow. You can't say that about dividends. Given the U.S. tax structure, repurchases might be more desirable then, due to those timing options provided to the stockholders, that is, the cash flow timing options. Now, the IRS, that's the Internal Revenue Service, the taxing authority in the United States, recognizes this and will not allow a stock repurchase for the sole purpose of allowing investors to avoid taxes. And so the firm might say things like, "We believe the shares are undervalued and therefore represent a good investment for the shareholders of our firm." They would never say, "We are doing this simply to allow our investors to avoid taxes." Just like with dividends, there is information to be had from the announcement of a stock repurchase. Stock repurchases send a positive signal that management believes that the current stock price is too low. And tender offers send a more positive signal than open market repurchase because the company is stating a specific price. Remember, in the open market repurchase, the company can choose when to repurchase and when to just hold back and wait. But a tender offer says, we think the stock is worth at least this amount of money. And the stock price often increases when repurchases are announced. In fact, that's what the finance literature overwhelmingly shows, is stock price increases upon announcement of repurchases. Okay, here we have a real repurchase announcement. America West Airlines, which no longer exists by itself, it was purchased by another airline, announced that its board of directors has authorized the purchase of up to 2.5 million shares. Now notice they didn't promise to purchase any amount of shares at all. They've just authorized the purchase of up to 2.5 million shares over the next 2 years as circumstances warrant. Remember earlier I told you they would buy back when stock prices were low and they thought the firm was undervalued? Following the approval of the stock repurchase program today by the board of directors, W.A. Franca, chairman and chief officer, said the stock repurchase program reflects our belief that America West stock may be an attractive investment opportunity for the company, and it underscores our commitment to enhancing long-term shareholder value. Notice they didn't say anything about allowing their shareholders to avoid paying taxes. The shares will be repurchased with cash on hand, but only if and to the extent that the company holds unrestricted cash in excess of $200 million to to ensure that an adequate level of cash and cash equivalents is maintained. In other words, they're letting you know that the stock repurchase is dependent on having cash in excess of $200 million on hand, and if cash falls below that, the company will not be making repurchases. Students are always surprised to find out how little we know in finance. There's just a lot out there that we don't quite grasp yet, but here are some things that we do know. First of all, corporations smooth dividends. What does that mean? It means that dividends grow at a much smoother rate than earnings. In other words, the volatility of earnings will be much greater than the volatility of dividends. Managers are reluctant to lower dividends because it sends a bad signal to the market. Conversely, they are reluctant to raise dividends because they might have to lower them in the future. And so this provides a natural smoothing to dividends. Secondly, we know that dividends do provide information to the market. When companies cut their dividends unexpectedly, stock prices drop. And when dividends are raised unexpectedly, stock prices rise. We do know that firms should follow a sensible dividend policy. What do we mean? Well, first of all, don't forgo positive net present value projects just to pay a dividend. That wouldn't be in keeping with the goal of financial management, which is to maximize shareholder wealth. We should also avoid issuing stock to pay dividends. In a world with no transactions costs and no taxes, it wouldn't matter one bit. But in the real world, we do have taxes, and we do have to pay transactions costs when we issue new stock. We call those flotation costs. And firms should consider a share repurchase when there are few better uses for the cash. For instance, Apple recently sitting on a large amount of cash, and paying that cash out as a dividend is one option, but they could also consider doing a share repurchase. So here's a quick recap. First of all, we know that aggregate payouts are massive and have increased over time. What do we mean by aggregate payouts? Dividends and repurchases. Dividends themselves are concentrated among a small number of large, mature firms. In other words, the kind of firms you might see in the S&P 500 are far more likely to pay dividends than the small young firms you'd find on NASDAQ. We know that managers are reluctant to cut dividends. Why? Because the market will punish them for it. Therefore, managers smooth dividends. Because they are reluctant to cut dividends, they are also reluctant to increase dividends. And we do know that stock prices react to unanticipated changes in dividends. Finance folks often have theories on the way things work, and then we go out and do surveys of managers to find out what they actually do. And what we find is that 93.8% try to avoid reducing dividends per share. We know that. This is the stickiness of dividends. 89.6% try to maintain a smooth dividend from year to year. But only 41.7% pay dividends to attract investors subject to prudent man restrictions. Now, what does that mean? First of all, prudent man restrictions require certain groups like pension funds to only invest in stocks that a prudent man would invest in. And typically that's been taken to mean a dividend-paying stock. And so basically what we are saying here is that 41.7% of managers actively seek to serve the clientele that desire dividends. Now, 84.1% say it's important to maintain consistency with historic dividend policy. 71.9% say it's important to maintain stability of future earnings. But only 9.3% consider flotation costs when making their decisions on whether or not to pay dividends. We as finance professors would think that this percentage should be much larger, because after all, issuing new equity is an expensive proposition. Next, we'll talk about stock dividends, and in my mind, stock dividends are not dividends at all. Why? Because the company is merely paying additional shares of stock instead of cash. That's like saying, if we cut a pizza in 20 slices instead of 16, everyone will get more pizza. It's a fallacy. All it does is increase the number of outstanding shares, but the accounting value of those shares for sure drops proportionally. So the book value of equity doesn't change one bit. Now they categorize this into small stock dividends, less than 20 to 25% is a small stock dividend. And here's the example. If you own 100 shares and the company declares a 10% stock dividend, you would receive an additional 10 shares. And we say a large stock dividend is one that's more than 20 to 25%. Now, in theory, this has no impact whatsoever on the value of the firm, but we do see large stock price gains at the announcement of a company's decision to issue a stock dividend. Why would this be? Well, perhaps there's some signaling thing that's going on here. This is a way for management to signal to the investors that the company is embarking on a growth phase. Also, we might see that this stock dividend causes the shares to be in a better trading range where dealers might be more willing to make a market in the shares. So there are a couple of theories on why this might be, but there's no good solid evidence to say that a stock dividend should increase share prices. Stock splits are essentially the same thing as a stock dividend, except that they're expressed as a ratio instead of as a percentage. For example, a 2-for-1 stock split is exactly the same thing as a 100% stock dividend. You start out with 1 shares, you end up with 2. You start out with 10 shares, you wind up with 20. Now the stock price is reduced when the stock splits. For instance, a 2-for-1 stock split should, in theory, cause the stock price to fall to half its previous level. But oftentimes we see it doesn't fall the entire distance. And so apparently there is some sort of news, good news, about stock splits. Now, a common explanation for stock splits, because we know they don't accomplish anything from an accounting perspective, is to return the share price to a more desirable trading range. For example, each share of Apple stock has gotten quite expensive, I believe around $500 per share at this point. Now, if Apple were to do a 10-for-1 share split, the stock would trade around $50 per share. There might be people who could afford a $50 share of stock that might not be able to afford a $500 share of stock, and as a result, Apple could broaden their stock ownership base by splitting their stock.